Well, we're down to the last couple of weeks before year end, and this is when people take a look at last minute tax planning ideas and tweak their taxes a little bit. So, I'm going to give you a few considerations for reducing taxes now. In fact, I'm going to give you about 15, and these are going to be geared mostly for high earning W 2 folks. Let's admit it, if you're a business owner, you have a lot more opportunity for tax planning than for high salaried execs. But the tax planning opportunities are still there. So if you're a high earning W 2 and you still want to do some tax planning in between now and year end, you still have some pretty good options. And you should take advantage of as many as you can because, again, it's a little bit more challenging for W 2 folks to reduce their taxes, but the opportunities are there. So let me walk you through about 15 of them. The first thing we say is to max out your company-sponsored employer retirement plan. If you're a high-income earner looking to reduce or defer your taxes, using a traditional 401k or a 403b is the first place to start because you can put as much as $23,000 away. If you're over 50, you have a $7,500 catch up, so you can put $30,500 away. And if you're high earning and lucky enough to be working for certain public nonprofits, maybe a hospital or an educational institution, you can have both a 403b and a 457, and the ability to put those contributions into each for $46,000 or $61,000. So these are really great tools. And I found that many high earners are not aware that they can do both in those institutions. So obviously, if you can put $61,000 away, you can make a significant dent in your taxes. Now, this may not be easy for all W-2 folks, especially if you still have children at home. But what I find is the folks that I work with who are within about 10 years of retirement, their kids are grown, their college obligations are behind them. This is when they really go for it and they max out those contributions because they have the bandwidth to do it and take a full advantage of maximum contributions. So it's great to do in the last few years before you're retiring. Now, the next thing you might want to consider is contributing to a mega backdoor Roth. And let's say you put $23,000 away into your pre-tax 401k or 403b, and your employer matches 10% of that. So the total contributions going in is $25,300. The annual maximum that you can put in between both employer and your contributions is $69,000. So in this case, a backdoor Roth 401k would allow you to put an additional $43,700 towards your retirement. So this is a great opportunity to fund your after-tax 401k and then convert it into this backdoor Roth. Because you've paid taxes, it's been an after-tax contribution. There's no taxes upon conversion unless there's been a little bit of growth in between the time that you put the money in and then withdrew it, and then you'll pay taxes on that. But you're still typically pretty far ahead. So the next thing you might want to consider is a backdoor Roth, and this is money where you put a contribution into a non-deductible IRA, and then you can convert it to a Roth IRA. You want to be sure that there's no other pre-tax IRAs laying around somewhere, old Simples, old SEPs, any rollover IRA, because if you do that, then it makes the withdrawals from this account taxable. So you want to just make sure that all of those are cleaned up in advance. If you do have some old IRAs, maybe you can roll it into your current retirement plan and then avoid that complication. So, but it's still a great opportunity to do a backdoor Roth. Now, the next thing you want to do is you want to max out your health savings account. I find these to be almost perfect savings vehicles because you have to be participating in a high deductible medical plan. But if you are, you can put $4,150 in tax deductible to your plan, $8,300 for a family. And the money goes in, there's no FICA, no Fed taxes, no state taxes. And the contributions work like other IRAs, where the money is deductible, the earnings grow tax-free, and then if you withdraw to pay for medical expenses, the withdrawals are tax-free as well. So they're almost perfect. But this is where I think people miss the full advantage is they use their HSAs almost like their flexible savings accounts. They put money in and then they withdraw to pay for their medical expenses. When the best use of these accounts is really to put your money in and then allow it to grow, the earnings to grow on a tax deferred basis until your retirement. Because it's in retirement that we see a lot of our healthcare expenses. Most often, most people will experience as much as $300,000 in healthcare expenses. And so if you have an account that allows you to pay those on a pre-tax basis, it's very advantageous. And in fact, if you allow the account to grow, the bulk of your account will be your earnings. So that's the best way to use an HSA. The next thing you might want to consider is to maximize your 529. And again, the advantages here are based upon the state that you live in. So as an example, Vermont offers a 10% tax credit on contributions up to $2,500 for individuals and $5,000 for married couples. So that if you maximize that contribution to your 529, you get a tax credit against your state taxes of $250 or $500. And when you consider that Vermont allows you to put up as much as $352,800 per beneficiary into a 529, you can accumulate some fairly significant tax savings. Now, if you're in a state like New Hampshire where there's no income taxes, there's no state tax credit. And so you want to consider the state that you're living in to determine the advantages for you. Next, you want to maximize all your dependent care funds, your flexible savings account that allows you to put money in for daycare expenses. And you want to contribute all if you can, because you make your daycare expenses pre-tax. So that's significant to pay your daycare expenses pre-tax versus after tax. Now, for those of you in the sandwich generation where you might even be taking care of your parents as well as your children, these monies can be used for parents' daycare as well, as long as they are a qualified individual. So you just want to plan well so that you put the amount of money in that you're confident that you're going to utilize, because it's a use it or lose it account by year end. Similar to your flexible savings account, which goes hand in hand with those dependent care accounts, except they're used for medical expenses. So again, you'd like to anticipate your medical expenses and put as much into your flexible savings account as you think you might spend for that particular year, because whether it's eyeglasses or contacts or dental work or other medical expenses, you put money into your flexible savings account, you reimburse yourself for your expenses on your medical expenses on a pre-tax basis, and turn your medical expenses into pre-tax expenses. So, but again, you want to anticipate exactly what you might use, because it's an account where if you don't use it, you lose it. So if at year end you've got about $1,000 left in your flexible savings account, make sure that you use it for some of these expenses. Now, the next two strategies go hand in hand, and year end is always a great time to take a look at your investments. Maybe it's time to tweak the portfolio. Maybe it's just simply time to rebalance it. And you may have some investments in plus and some that maybe have gone lower, even to the extent that there may be some losses. And so this is a perfect opportunity for you to do some tax loss harvesting. Sell those investments that will realize some losses for you. And you can always repurchase in 31 days or find a similar investment and reinvest. But you can take losses to fully cover any capital gains that you have for the year, as well as $3,000 against your active income. So tax loss harvesting is a great year-end strategy as well. And while you're taking your losses, you may as well take a look at your gains too. And maybe you have a stock that's in a great, like an NVIDIA, that has doubled in value for you. And you want to take some of those gains because it makes sense for your portfolio. If you've identified losses, you can take gains equivalent to those losses so that there is no tax going to be paid on the gain. And for most portfolios, there will be gains and losses, but in some years, you don't have losses. And so you only have gains. That was true for the last couple of years where the market has been good to us. And so this is where direct indexing can help. If you contribute some of your stocks into a direct indexed account, maybe it's an S&P 500 direct index, there's always some stocks in a loss position in the S&P 500 in any particular year. And so what your manager will do is they will harvest some losses to offset your gains so that direct indexing can allow you to find losses to shelter gains. So consider direct indexing if you have large gains or even if you have concentrated stock positions that you're trying to unwind. Now, as you're looking at your investments, it's also a good time to consider your investment location. So often we see people with investments in their brokerage accounts or their taxable accounts that are generating taxable income for them, either dividends or interest. And so if that's the case for you, it is a consideration to take those investments and put them into your tax deferred account because that's where they belong. Dividend and interest generating investments should be in tax deferred accounts if you're in a high tax bracket. And only those growth oriented things that don't generate that sort of income should be in your taxable accounts. So we also find people are still using mutual funds, and the mutual funds have to make their capital gains distributions before year end. And so this again complicates your taxes. So if there's a mutual fund that you really like, maybe that should be something that you own in your tax deferred accounts as well. And all of this can be done during a portfolio review. Now, this could also be the opportunity to consider about a Roth conversion. Maybe this has been a year that you've left your job. Maybe it's a year that you've taken a sabbatical or changed jobs. Or maybe it's just the first few years of your retirement before you take Social Security. And this is an opportunity for you to take some withdrawals from your tax deferred accounts in a year that your tax bracket might be lower. So if during working years you were in a 32% bracket, but this year, for whatever reason, you might be in a 12, 22, or 24% bracket, and you feel that this bracket is going to be lower than your retirement year brackets, it could be a perfect opportunity for you to convert some of your pre-tax savings to Roth savings. So you have some tax diversification in retirement, filling up that lower tax bracket. And this is perfect for W-2 earners who have not had the opportunity to save in Roth accounts. Maybe they haven't had a Roth 401k available to them. So it allows you to build some tax-free income for your retirement years while you're temporarily in a lower tax bracket than you're going to be in those future years. So it allows you to lower your effective tax rate over the years. Now, the next thing to consider is donating cash to charity. And donating cash to charity serves as a deduction against your active income, but it only works if you itemize your deductions. So maybe your charitable inclination in any given year is less than your standard deduction. And this can happen, particularly with the increase of our standard deduction. So if that's the case, if what you want to give to charity is lower than your standard deduction, this is where we recommend that people bunch their charitable deductions, maybe into 1 year. This year's and next year's together, you put together, and when you put them together, they're higher than your standard deduction. So what we recommend is people bunch deductions 1 year and maybe take their standard deduction the next year. Bunch deductions the next year, take their standard deduction after this. And so that in any one particular year, you can fully deduct your cash charitable contributions. The next thing to consider is giving appreciated stock to a charity. A lot of times you can't do this directly to a charity, so you can do it to a donor advised fund. But the idea is if you've got a $40,000 gain in a stock that you're going to pay a 15% capital gains tax against, you can give that stock directly to your donor advised fund without selling it, saving the $6,000 in taxes and getting the full $40,000 deduction. You can then direct your donor advised fund to send the money to whatever charity you want. They sell the stock and then send the funds to those charities that you might want to receive them. So now the next thing is real estate can be a great investment for W-2 earners because you might have some profitable real estate. You've taken some deductions in the early years of your ownership, and now you may be considering buying another property. When you buy that property, you might do a cost segregation that allows you to take some bonus depreciation and use that bonus depreciation against the other profitable properties. So giving some consideration to acquiring real estate for this purpose can help, because you can take that bonus depreciation against real estate income. If you qualify for active participation, you can take that against your active income as well. Now, the next thing is if you've taken a large capital gain this year, you can reinvest those proceeds into a qualified opportunity zone, those areas that the government has determined deserve investment, and you can defer that gain for 10 years. If your gain is in real estate, you can also defer that gain by using a 1031 exchange. And so the qualified opportunity zone is for a gain in any transaction where you've seen a capital gain. The 1031 allows you to defer gains in real estate transactions. So it's something, if you know you want to reinvest into another piece of property, it's something that allows you to defer that gain as well. So 1031 exchanges, qualified opportunity zones allow you to defer large gains in transactions that are both real estate and non-real estate. And then the final thing I'd suggest is that you prepay property taxes. You can do this. Lots of times we see people who have fluctuations from year to year in their incomes, higher incomes in some years, lower incomes in other years. And so we recommend in those years that they have experienced some high income, that they prepay the next year's property taxes this year, where the deduction against their income may be more worthwhile. And so this isn't a great tax saving strategy, but is one that when put together with all of the other strategies that we've talked about, they can accumulate some significant tax savings. So if you're a high earning W-2 person, tax planning is important. It is limited, but I think if you take advantage of the majority of the ones that we've talked about today, you can significantly address your taxes over the years. So thanks for watching. If you liked the video, give me a like below. If you liked this video, look at other content on our channel. And if you have any thoughts, please leave them in the comments below, because I always respond to them as well. Again, thank you for visiting my channel.